inflation. And if we have to move more quickly, we are prepared to do that. So I'm not going to rule out a 50 basis point move in the future.
Thank you. Is the Bank of Canada satisfied that there are adequate measures in place to protect our financial system from cyber attacks?
You can never be complacent about cyber attacks. But I will say that the financial system has among the most advanced protection. I can also tell you that the Office of the Superintendent of Financial Institutions, which oversees our financial system, is certainly alert to that, and that is one of the things they regularly assess as part of their supervision of our banking system. The Bank of Canada also chairs a coordinating group with public security and the government's cyber system, together with the financial system, to try to make sure everybody's working with the best available information and shares the best available technology and how to best protect us from this threat. Look, cyber risks are out there. We have to be very alert to them, and we have to continue to invest to stay ahead of the bad guys.
Yes. Back to inflation. Can you explain how much of the inflation growth is due to higher energy costs? And is there a sense as to the impact that higher oil prices, or what higher oil prices will have on GDP growth?
So so inflation is just over 5%. So if you break that down, about 2.5 percentage points, or about half of the 5%, reflects goods that are experiencing serious supply constraints. So about half of that 5% is goods where there are serious disruptions to supply. There's about an extra percentage point of inflation coming from energy. Now, in the last several weeks, energy prices, oil prices in particular, have moved up sharply. I looked at the screen before I came down. Oil prices were about $110. So relative to where we are now, that would probably, you could expect just the direct, so if a price of $110 were to be maintained, you could expect that would add about another further percentage point to inflation. There are also higher, other commodity prices have also gone up, food prices, for example. And if these higher energy prices are maintained, there could also be some higher transportation costs, so some more direct effects. So also say, particularly since the invasion, we've seen a lot more volatility in these prices. I'm not going to give you a new forecast, but what's pretty clear is that they are going to add further to inflation in the near term, and we can expect inflation to be higher in the near term as a result. With respect to your question on income, well, look, obviously, these higher prices are going to impact Canadians fairly quickly. They're going to see it fairly quickly at the gas pump. They may start to see it in the grocery store. And so, I mean, that's going to hit them right in the pocketbook. The other element, though, is that Canada actually is a big net exporter of many of these goods. We're a big net exporter of oil, wheat, potash, nickel, for example. When those prices are higher in global markets, that means our export, more income comes into our country. We get more for every unit that's exported. So that will tend to increase income. When you look at, though, the overall impact of this invasion, it's also going to have effects on confidence. It's going to it may disrupt supply chains. As I stressed earlier, we're just a week into this, and we'll be having to assess the full overall impact.
Thank you. In your speech, you touched on how unavoidable inflation has been impacting households. What is your outlook on wage growth? And do you think it will rise in line with inflation?
So wage growth through the pandemic was was very low, and it has been coming back up to. It's now back up to roughly pre-pandemic levels. And the key for and what we're certainly what we're hearing from employers is they're having trouble finding all the workers they want. Vacancies are high, and their expectations are that wages will go up further. And the key to wages is that productivity growth and wages need to go up together. As long as productivity grows up with wages, the productivity growth pays for those higher wages. So they're not inflationary. A few weeks ago, I spoke to the Canadian Chamber of Commerce, highlighting the importance of business investment, because when businesses invest, that gives workers better tools. That makes workers more productive, and that means that higher wages are not inflationary. The fourth quarter national accounts that were just published on Tuesday, there was some good news in there. Business investment was very strong in the fourth quarter, and in fact, there were some historical revisions suggesting that it was even stronger than we thought through parts of the pandemic. And when you look at our own surveys of businesses, what we hear is that investment intentions have never been stronger. So that is a very good sign that businesses are going to be investing. That's going to grow the capacity, and that can sustain higher wages. Where we would get worried is if wages started to run significantly above productivity growth. If that happens, they can start to become an independent source of inflationary pressures. We're not seeing that yet, but that is certainly something we're watching closely.
Thank you. And our last question. Much has been made of real estate's substantial contribution to GDP growth over the last decade or more. As that growth becomes more tepid, what sectors do you expect may pick up the slack?
Well, actually, what we've seen through this pandemic is that the key drivers of growth have been household consumption and housing. And we expect that they will both remain reasonably solid. We do expect some moderation in growth from housing, but we expect it to continue to grow. Immigration is coming back. People have jobs. Wages are going up, so incomes are good. So even with interest rates rising, we do expect to see solid demand for housing, but some moderation in the growth. What do we expect to see? Is we expect to see some broadening of growth. And in fact, we saw that in the fourth quarter. And by broadening, I mean more business investment, more exports. They were both quite strong in the fourth quarter. And we would hope to see that is sustained. The U.S. economy, our biggest export market, is growing strongly. They've also got, they're also probably already slightly in excess demand. So that means that they are going to be looking for our imports. That's going to create solid demand for our exports. And businesses are telling us they're hitting up capacity constraints. As I just mentioned, their investment intentions have never been stronger. So there's good reasons to believe we're going to see both stronger investment and stronger exports. And that will broaden the recovery and really is key to sustaining solid growth.
Thank you. Thank you so much, Governor, for sharing with us your views on how you're going to deploy all of the tools at your disposal in terms of rising rates and QT in such a thoughtful and transparent way that Canadians can follow and understand. And we know that you're taking into consideration everything that's affecting all of us personally as well as internationally. We take comfort in also knowing that the supply chain issues are starting to subside a little bit. Also that the Canadian economy is so strong as a result of all the proper stimulus that's taken place, and that Canadians will actually benefit from some higher prices as well. So it's nice to know that as well. We thank you and your team for your leadership and stewardship in such challenging times. We hope that everyone enjoyed this session today. Thank you again for joining us. And on behalf of CFA Society Toronto, we wish you a good rest of the day and evening. Goodbye for now.
Thank you for having me.
Our pleasure. Good afternoon and welcome all. My name is Sue Lemon, CEO of CFA Society Toronto, and I would like to welcome everyone to today's Economic Progress Report presented by Bank of Canada Governor Tiff Macklem. CFA Society Toronto and the Bank of Canada would like to acknowledge that we are speaking from the land of First Nations, Inuit, and Métis people. Myself from the traditional territory of many nations, including the Wendat, the Anishinaabe, the Haudenosaunee, the Métis, and the Mississaugas of the Credit. And Governor Macklem from the traditional unceded territory of the Algonquin Anishinaabe people. We pay our respect to Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. A few housekeeping notes. If you have any questions at any point in time during this session, please add them to the Q&A section. You should see a question box at the right side of the screen. Please write your name, email, and question in there, and then click Submit. It is now my pleasure to welcome our guest speaker, Tiff Macklem, Governor of the Bank of Canada. Tiff Macklem was appointed Governor of the Bank of Canada in June 2020 for a 7-year term. Mr. Macklem first joined the Bank of Canada in 1984 and held various senior positions, including Chief of Research and advisor to the governor. He was appointed a deputy governor in 2004 and senior deputy governor in 2010. During the global financial crisis, Mr. Macklem was associate deputy minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. From 2014 until his appointment as governor, Mr. Macklem was the dean of the Rotman School of Management at the University of Toronto. Governor Macklem, we look forward to hearing your comments today.
Well, thank you for that introduction, Sue, and it is a pleasure to be with you today to provide an economic update. And I also want to discuss both our monetary policy decision yesterday and what Canadians can expect from us going forward. Before I begin, I do want to acknowledge the shocking developments that have taken place in the past week in Ukraine. The senseless loss of human life and the devastating impact of this unprovoked Russian invasion on the Ukraine people are beyond comprehension. I know this is an extremely anxious time for the many Canadians who have family and friends in Ukraine, and my thoughts are with you. The invasion is also a major new source of uncertainty and volatility in the global economy. The situation is fluid, and we are following events closely and will be assessing the ongoing economic impacts. These events come just as we approach the 2-year mark of the COVID-19 pandemic. The economic recovery from the pandemic has been impressive. While uncertainty about the evolution of the virus remains, the agility and resilience of Canadian households and businesses through the past 2 years of immense challenge cannot be overstated. And after providing extraordinary stimulus to support the economy through this tremendous shock, we are now clearly on a path to normalizing monetary policy. That's what I'd like to discuss with you today. In January, when the Bank of Canada released its quarterly monetary policy report, we told Canadians that emergency monetary policy measures needed to support the economy through the pandemic were no longer required. We ended our exceptional forward guidance and told Canadians they should expect a rising path for interest rates. Yesterday, Governing Council took the decision to raise the policy rate by 25 basis points to 0.5%. This is the first step on that path. We also said that we will be considering when to end the reinvestment phase of our large-scale asset purchases and allow the bank's holdings of Government of Canada bonds to begin to decline. This process is known as quantitative tightening, or QT. The timing and pace of further increases in the policy rate and the start of QT will be guided by the bank's ongoing assessment of the economy and its commitment to achieving the 2% inflation target. Hier, le conseil de direction a augmenté le taux directeur de 25 points de base. Le taux est donc passé à 1,5%. C'est un premier pas vers une remontée des taux d'intérêt. Le Conseil va aussi évaluer quand il mettra fin à la phase de réinvestissement et laissera notre portefeuille d'obligations du gouvernement du Canada commencer à diminuer. Ce processus s'appelle le resserrement quantitatif. Le moment et le rythme des hausses subséquentes de taux directeurs et le début du resserrement quantitatif seront guidés par l'évaluation continue que fait la Banque de l'économie et par son engagement à atteindre la cible d'inflation de 2%. Today, I will provide an update on economic developments with a focus on inflation and the forces behind it. I'm also going to review the role of monetary policy in bringing inflation back to target. And finally, I want to look ahead to the next phase of our balance sheet management and the mechanics of QT. Like so many things that have happened during the pandemic, this will be new territory for Canadians. And I want to ensure that the process is clear and transparent ahead of time so that everyone understands what comes next. The Canadian economy is robust. GDP growth in the fourth quarter was very strong at 6.7%. This has reinforced our view that economic slack in the economy has been absorbed. And growth in the first quarter looks more solid than previously projected. As expected, inflation remained high. Inflation control is our #1 job at the bank, so I want to explain what is driving these price increases and what Canadians can expect looking ahead. Since last spring, CPI inflation surged well above our target range of 1% to 3%. In January, CPI inflation was 5.1%. The Russian invasion of Ukraine is driving up international prices for oil, wheat, and other commodities. This will put further upward pressure on inflation in Canada and around the world. Setting aside the crisis in Ukraine, the surge in inflation we have seen since last spring largely reflects pandemic-related shifts in global supply and demand. But this rise in inflation has been larger than we expected 6 months ago, and price increases have broadened. So I want to take a closer look at the forces at play. One indication of the unusual forces at play is the large gap that has opened up between different measures of core inflation. All three of our core measures have increased in recent months. CPI common, which is more related to inflation in services and less influenced by global supply disruptions, was only 2.3% in January. In contrast, CPI median and CPI trim, which have been more influenced by the prices of globally traded goods, were 3.3% and 4% respectively. The inflation story in Canada has three key elements. The first is the global shift towards goods and away from services during the pandemic, combined with pandemic-related disruptions to the production and delivery of goods. The second is a broadening of price increases to everyday items like groceries and gasoline. This is making it more difficult for consumers to avoid paying higher prices. And the third is the strength of the Canadian recovery and the overall balance between demand and supply in the economy. These elements are all interacting, but I'd like to take them each in turn. In the 2 decades before the pandemic, price inflation for goods was generally low, indeed on average well below our 2% target for overall inflation. This reflects a combination of factors. Innovation drove prices of many goods lower, particularly for computers and other goods with embedded technology. Increasingly specialized and efficient global supply chains, together with reductions in international shipping costs, also put downward pressure on goods prices in Canada and around the world. In contrast, the prices of many in-person services that are necessarily more local and more labor-intensive saw larger price increases on average. Between 2015 and 2019, goods inflation averaged 1%, while services inflation, excluding shelter, averaged 2.4%. The pandemic has dramatically shifted the relative pressures on the prices of goods and services. Stuck at home, Canadians and indeed consumers in most countries have spent less on services such as gym memberships or travel. As a result, many services prices have been rising more slowly than usual. In January, the rate of increase in prices of services excluding shelter was 1.6% in Canada. But unable to buy the services they wanted, consumers shifted to goods. Canadians have bought exercise bikes, office furniture, electronics to help cope with living, working, and playing at home. This has put upward pressure on goods prices. Supply problems have substantially exacerbated the situation. Just as consumers were spending more on goods, the supply of these goods was squeezed as health concerns hit overseas factories and ports became congested. Pandemic-related restrictions and precautions around the world have limited production and slowed the delivery of goods. This double whammy of higher demand and impaired supply has resulted in sharply higher prices for many goods. In January, goods price inflation in Canada was 7.2%. The last time it was that high was January 1983, when overall inflation was 8.2%. As the pandemic recedes, we can expect consumers to shift back to spending more on services, and this should take some pressure off the demand for goods. We can also expect supply chains to normalize. But predicting how long this will take is difficult. And the war in Ukraine is compounding this difficulty, as it could also disrupt global supply chains. As you might expect, we have been working hard to better understand and track supply chain disruptions. Our near-term outlook for inflation depends importantly on how they evolve. We're closely tracking new and different sources of data that tell us more about shortages, logistics, and shipping costs. What is clear is that supply chains remain highly disrupted. But the data also show us some tentative signs of improvement. Manufacturers in Canada are starting to receive inputs a little quicker, and global transportation bottlenecks have eased slightly. Canadian motor vehicle production has also begun to recover from slowdowns caused by shortages of semiconductors. But global shortages of key commodities remain a challenge. Overall, we expect global demand and supply of goods to gradually come into better balance through 2022. The second element of the inflation story in Canada has been a broadening of inflation beyond the items that are directly affected by supply chain disruptions. The bounce back in energy prices from pandemic lows has been contributing to inflation for more than a year now. But a combination of strong demand growth, limited investment, and geopolitical risks has now pushed oil prices well above pre-pandemic levels. This is boosting CPI inflation directly and is adding to already high transportation costs. These higher costs are affecting an increasingly broad spectrum of goods. In addition, extreme weather has reduced harvests in Canada and in other growing regions, and this is pushing up food prices. And in Canada, strong demand for housing combined with higher costs for building materials is pushing up new house prices, increasing the shelter component of CPI inflation. One way to measure this broadening of price pressures is to look at how many CPI components are seeing high rates of inflation. As of January, across 165 CPI components, almost 2/3 were growing above 3%. This includes gas and groceries necessities, whose prices Canadians see daily. Grocery prices are up 6.5% from last year, and everyday foods that are hard to substitute, such as beef, chicken, and cereal, are all getting more expensive. This broadening in price pressures is a big concern. It is making it more difficult for Canadians to avoid inflation, no matter how patient or prudent they are as shoppers. This is affecting the most vulnerable Canadians the most. It also increases the risk that households and businesses will begin to expect large price increases to continue, and this becomes embedded in long-term inflation expectations. The lesson from history is that if inflation expectations become unmoored, it becomes much more costly to get inflation back to target. So far, long-term inflation